Hey there, welcome to episode 1 of MoneyCasts. I'm Kevin Vu, and today I'll be showing you how a loan works. Let's see how Investopedia defines a loan. Feel free to pause here if you want to read the whole definition. This is a thorough and accurate definition of a loan, but let's try to break it down more simply. A loan is a two-part agreement in which I, the lender, give money to you, the borrower, which you pay back at a later time. Let's look at a real-world example of a loan. Today I got into an accident, which is pretty bad since I need my car to drive to work. I'm looking to buy a modest compact car that costs $20,000. I only have $10,000 though. Normally I make $2,000 per month, but if I don't have a car I'll have to take the bus to work and I won't be able to work as long. So I'll make $1,500 per month without a car. I'd like to buy that car now, but I don't have enough money. This is a great time for a loan. I'll take out a 1-year loan for $12,000 at an interest rate of 5% from my bank, so I can buy the car right now. Let's learn each of these terms before moving on. The principal, which is the amount of money I initially borrowed from the bank, is $12,000. The term, which is the time that I have to pay back the principal of the loan and any interest, is 1 year. The frequency is how often I have to make payments on my loan. In this case, I'll pay off my loan or pay part of my loan off each month. The interest rate of the loan is 5% and yearly. This means in addition to paying back the $12,000, I'll also have to pay 5% of that $12,000 in interest each year, which ends up being $600 since the term is only one year. The interest rate is simple interest as opposed to compound interest. I'll cover interest rate, interest, and interest type in more depth in a later lesson, but it's important to grasp that the interest is essentially the cost of the loan. So the end result of this transaction is that I took out a loan that totals to $12,600 with principal and interest, and that I bought my car today. Since I need to pay this off in a year and I'm making monthly payments, I'll make 12 monthly payments of $1,050 each. Now looking back, why did I need a loan? Why couldn't I have just waited a few months or a year to buy the car? Let's compare getting a loan versus buying the car outright, which means paying all costs upfront in cash. Although I save $600 in interest when I buy the car outright, I lose $6,000 in salary because I don't have a car. Through this example, we've grasped the basic conditions in which you should use a loan. You use a loan when number 1, you need to buy something now, not later. 2, you need money to buy something. And 3, you know you will be able to pay off the loan that you make. This basic definition of a loan correlates with the questions you'll be asking yourself when making any financial decision. Number 1, do I need to buy this now? Number 2, how much money do I need to buy this? And number 3, what kind of loan should I get to buy this and be able to repay the loan? The upcoming MoneyCast will be dedicated to answering these questions. That's all for today. Once again, I'm Kevin Vu, and I want to thank you for watching this episode of MoneyCast. Next episode, we'll be looking at how interest works.